Good morning, everybody. Welcome to another TipRanks webinar. And if this is your very first webinar, my name is Ari Gutman. Every single week, I am jumping on webinars on Mondays and Wednesdays to essentially do exactly what TipRanks is here to do and helping to level the playing field for all investors. So guys, we have two guests with us on today's webinar that I'm incredibly excited to introduce. The first guest I actually want to share is my boss. That is Uri, and he is here with us, and we're going to put him on the hot seat and actually talk about the year ahead of us and what TipRanks has to offer. Now, our second guest speaker, guys, is actually none other than Eliot Spitzer, former governor of New York, and most importantly for our call here, guys, the man who is known as the sheriff of Wall Street. It cannot get better than that in terms of making sure that we are leveling the playing field and, of course, remaining as transparent as possible. So I'm going to go ahead and spotlight their screens for us, and we're going to dive right in, getting started with asking Uri some questions. Uri, right off the bat, I want to go ahead and ask you, as the TipRanks CEO and founder, for those of us who are brand new to TipRanks, just joining the community, what exactly is the TipRanks story? How did it all come to be?
So the story actually started from a personal need of bringing transparency to retail investors such as myself. So I'm a software engineer by education, and I worked for many high-tech companies in Israel. And one of my side hobbies was to invest in the capital markets. And as all investors do, I followed an advice that I came across online, and it turned out to be a pretty bad advice. And then my wife asked me, why did you put your yearly bonus on a stock you know nothing about? And I tried to explain to her how persuasive this analyst who wrote, 3 reasons I should invest in that was. So I actually started Googling his name to read the story again. And I created a spreadsheet to see what else he recommended. And it kind of shocked me that in 2012, after a 4-year of bull run, he was wrong most of the times. And, I thought to myself, with my technology background, I can probably write a software that does it for me, that scrapes the internet, starts to collect what everyone is recommending out there, and gives you a scorecard based on how accurate it was. And we came with the concept of creating the world's first financial accountability engine. And that took off because of the great team that we built, because of the great investors that we brought. And we leveraged that success to turn TipRanks into a more robust research platform that today serves many millions of investors. So we were lucky, and the timing was good, and there was a strong need.
Wow. Now I got to ask, just if anyone's, I know I'm wondering, do you remember what stock that was and what analyst, or can we disclose that?
Sure. So the stock was Tata Motors. And I knew nothing about it. It's kind of funny. It was trading for, I think, $20 per share back then. And I remember traveling in India about a year before, and I thought, well, you know what? I do see the name all over, the streets of India. I was aware of the company, but I knew nothing about the business. And I remember telling it to a friend of mine who was very tech-oriented, and he said, what are you doing? If anything, invest in Tesla. Look at their technology. And I'm like, you don't know what you're talking about. So long story short, Tesla went up 10,000 times, and Tata went down about 60%. And the expert that made this recommendation is actually an Israeli analyst. And it's funny because he knows the story is about him. And I ran into him a few months ago, and I thanked him for his bad advice.
Now, I'm sure your wife may have also thanked him for that bad advice as well.
He just wants to get the credit for the story.
Don't we all? Now, the next question I want to ask you, because we obviously have the sheriff of Wall Street here with us, but how exactly did your path even cross paths with Mr. Eliot Spitzer's path? How did this relationship begin? Where did it start? How did it unfold?
So it's actually a very a funny story. I remember when we just came up with the concept of financial accountability, I was sitting with my friend and co-founder, Gilad, and he asked me, if you had to bring one influencer to join, who would that be? And I told him about the global settlement and the regulation that Eliot has led as part of his role as the Attorney General. And I told him we need someone like that understands the pain that investors have. And it seemed like a long shot, of course. Yeah, I mean, we weren't holding our breath, and we never thought it would actually happen. It was just, a naive discussion between two founders who knew nothing. And fast forward about 6 months after, we started to have a business. We did this very successful demo at San Francisco at this big event, and we started getting some visibility. And then we hired a marketing manager who joined TipRanks. And prior to that, she worked at New York at the Israeli consul. And I told her, do you know how we can get to Eliot Spitzer? And she said, yeah, we used to invite him to a lot of events. Let me get his email. Now, I remember she gave me his email, and I sat and, I thought, how can I get his attention? Because he's probably getting so many emails every day. So I tried to use keywords that I thought would resonate well with him, like transparency. I remember that the subject had, an Israeli startup, because Israel has a good reputation in creating technology. And I sent the email. And after that, the entire company, I mean, we were 6 employees, so the entire company is maybe a bit exaggerating. But I remember we went out to dinner to celebrate this. And, we're sitting at dinner at a restaurant in Israel, and suddenly I see a mail back from Eliot. Says, hey, this looks pretty cool. Come see me in 2 days at my office. And I'm scratching my head. So I asked our marketing manager, are you sure this is the same Eliot Spitzer that I'm referring to? I wanted to make sure that I'm not flying to New York to meet another Eliot. And she said, yes, it's him. So I booked a flight, and I met Eliot, and he was very helpful. He was very affirmative. And I think it's fair to say that we even became good friends.
Wow. What a small world. Yeah. Now, I'm going to jump over to Eliot, our sheriff of Wall Street that has joined us. Now, Eliot, you were the attorney general from 1999 to 2006, an impressive background and history before you even got to being an attorney general. But from my understanding, you're attorney general, and usually you're going after landlords, maybe auto body shops, some mom and pops, nursing homes, businesses that may be doing something a little crooked, if you will. But from that time period, 1999 to 2006, the sheriff of Wall Street was in office there as attorney general, and you did something that Congress totally failed to do and perhaps is still failing to do. You also did something that really the SEC failed to do and may perhaps still be failing to do, which was taking on head-on Wall Street. What led you down that road? I mean, that's an ambitious takedown, but you did it successfully. Can you talk a little bit about that?
Sure. Absolutely. First, let me just congratulate Uri, because the story is correct about how I got this email. And I said, this is a fascinating idea that from the prism through which I viewed it, it was a market-based answer to the regulatory problem we had tried to solve. Now, that sounds like a bunch of words. We tried to impose on Wall Street a regulatory answer to separate analytical work from underwriting, okay? Because the problem was the convergence of the two, and all their desire to get the underwriting feeds had been a cancer in their analytical advice, and they were corrupted, thoroughly bad. And Uri saw it as an investor, and we saw it through the emails. I won't recount those stories. There's some great stories there. But what Uri came up with was an answer that said, let's just get out transparency, the critical word here, saying give to investors the information about what these analysts are really saying and doing and what their track record is. Because like so much in life, if you go to a horse race, you want to know, did that horse come in last before its last 10 races? If the analyst was wrong the last 10 times, you're not going to rely on that analyst. And so Uri's wisdom, which like most pieces of wisdom was very simple, was get investors that critical information. So when I saw the email, I said, this is cool. And Uri's exactly right. We've become friends. And I'm just so thrilled his company, which, I'm on the board. I own a tiny, tiny, tiny piece of. Uri has built an amazing company, and investors should be thrilled at the wisdom they can get from the website. So hats off to Uri for doing something really important. Now, why did we do what we did? Look, I had been a prosecutor before I was attorney general, done organized crime cases, taken down the Gambino crime family, pieces of it at least. So we did big things. And my view was, this is a very egocentric New York thing to say. New York is still the center of the world. And if you're the Attorney General of New York, we don't care what goes on in Washington. And so we had the jurisdiction, this being New York, we had the statutes, anti-fraud statutes, common law principles to use. And we did it not only with Wall Street, but with big pharma, environmental cases, labor cases. We said, how do you use the law to make a difference? And the law is the most magical thing in the world. I know I sound like a geeky lawyer when I say it. It's what separates uncivilized from civilized societies. We use the law in a principled way to set out some principles on Wall Street, and Uri has taken it to the next step through a company that does this in a remarkable way.
Wow. Now I want to dig in just a little bit deeper here. You got that email from some stranger, if you will, which was Uri,
Right.
but this stranger in your email, your inbox, you're
Right.
reading it. Now you had the massive takedown. What were your initial thoughts? Did you think this like TipRanks, the idea was achievable? Did you think Uri was the right guy for the job when you met him? I want to like dig in just a little deeper here.
Well,
Now we're all friends.
Okay. First of all, I didn't say I'm going over to see you. I hedged my bet. I said, you want to talk to me, you come here. Burden's on you. And so first, Uri had a lot more hair. Didn't have the beard because he didn't need the beard to make up for the loss of hair up top. He was younger, the same enthusiasm, and you need that. As a startup, you need enthusiasm. You need the belief that you're going to make 10 mistakes, but the 11th time it may work. And he came over here based upon the little story of his own investing that captured the larger story of what most investors go through in the real world, and said, how do we build something, a platform that permits this information to get out there? And there were starts and fits in terms of how the platform looked and how they built the software a little bit. But Uri had the wisdom, the enthusiasm, and what he said earlier is exactly right. Israel is startup nation, right? And Uri came out of that ethos and that environment where you had the software capacity, the intellect, the hard work. And I said, yeah, this is going to be fun. Okay, just so it's clear, I've gotten a lot of other offers from other people to join boards or to invest with them. People I'd prosecuted who would come to me and said, we want your stamp of approval because we're now clean. And I said, no, I don't do that. I'm not good housekeeping. I'm not giving you a stamp of approval. First, I don't know if you're clean now, and say, I just don't do that. But Uri's idea captured me because it went right to the nub of what we were trying to do, but it had a market-based answer, which is to give the information out there. And I remember when we first went on CNBC to explain it, everybody's eyes opened kind of widely, and they said, wow, that's cool. That's right. If you can have a website that explains how analysts have done, that's useful. And, other people have tried to imitate it. As Uri knows, there are funds that now replicate either positively or negatively the advice that certain people on TV give because they think they're good or their wisdom is good or bad. But I think as a coherent answer to the problem, TipRanks is the place to go. I wish I'd been wearing my TipRanks sweatshirt this morning. I wear it wherever I can. I'm proud to wear the logo. But I think this was the idea that I thought went to the conflicts of interest that were the root of the corruption on Wall Street.
It's really incredible to hear. I got to be honest, that's the same messaging that actually brought me to TipRanks. I had a message come in my inbox, not from Uri himself, but from a team member here. Now it's a colleague of mine. And it made sense to me because as an investor, and as quite honestly, a younger investor, looking around, who really do I trust? And that's across, family members, peers, colleagues, friends. Who do we trust? Who do we turn to? And that's where it was a no-brainer for me to say, this is definitely a team that I want to run with, that I want to work with.
Let me tell you a little story that I think is emblematic. I'll tell it quickly. And it has the virtue of truth, even though it used to be in politics. Most of the stories they tell are true. And this one is almost word for word true. Sitting in my office early on in the prosecutions of what we call the analyst cases, and we made many other cases on Wall Street, other sectors, but talking to the lawyers from Merrill Lynch, which was our first case, the first complaint we filed detailed all the Merrill Lynch violations of law and fiduciary duty. And the lawyers came in and they didn't tell me what lawyers normally tell you, which is you misunderstand the industry, or you took the emails out of context, or this one rogue employee doesn't represent the company itself. All the things lawyers do to limit the liability of the company. They looked at me and the first thing they said to me was, you're right about our central premise. You're right that these are fundamentally wrong, misleading pieces of advice that are being rendered, and they're wrong because we're trying to get the underwriting. But they said, but here's the quote, we're not as bad as Goldman. That was their defense.
Wow.
They said, we're not as bad as Goldman Sachs. And I looked at them and I said, I've prosecuted a lot of people. And the guy who I'm prosecuting for murder, if he stands up and says, Your Honor, he's right, I did that murder, but the guy over there did 10, doesn't matter. It doesn't matter. You still committed the crime. And so there was this sense on Wall Street that since everybody was doing it, it not only had become acceptable, but more important, it put the lie to the notion that Wall Street was propagating at the time that self-regulation would solve all these problems. Remember, there was the era of self-regulation. Trust us, we'll self-report if there's a problem. It was junk. In truth, they looked at each other and each of them lowered the standard of behavior because the other guy was going to undercut it. And so they dropped to a lower common denominator and they defined a new level of deviancy and misleading the public. It was terrible. Greed
always seems to get everybody with a sense of power there. Unfortunately, that actually leads me right to my next question, Eliot. That's for you. I mean, our mission here at TipRanks is leveling the playing field for all investors. Do you think, at least from your time in office as Attorney General to present, do you think the playing field has leveled, or do you think we've made progress? Do you think we have a lot of work still to do?
Well, here's my response. I think the information flow in the world is more level now because of technology, because of things such as TipRanks, what Uri has done, because there is disclosure that goes out over technological portals that everybody can see. Not because of regulatory moves necessarily, but I think technology has leveled the playing field. But having said that, I think for the ordinary investor, taking advantage of that is much more difficult, which is why you see the Citadels of the world, the high frequency traders, you see the mega hedge funds that have the capacity to harness that information, the quants. They have a distinct and perhaps insurmountable lead over the ordinary investor who wants to buy 100 shares of Tesla this morning because he thinks Tesla is going to report a bigger profit, right? Now, I'm not saying you can't participate in that way, but I think even though information flows more even-handedly, it's harder to take advantage of it because of the technology that now equips some of the real high-speed traders to be there first.
Sure. So now as we move into 2023, and something that, as I mentioned to kick off the webinar that we do here at TipRanks with our Monday and Wednesday webinars, is we paint our economic backdrop and then we dive into a TipRanks tool to see how best to use it. But something that I think is incredibly important is understanding that the stock market is a forward-moving vehicle, right? We have to think about not yesterday, not 6 months ago, but where we are right now today and looking ahead 6 months, 1 year, 2 years, 10 years out, to try our best, not that anybody can predict it accurately, but try our best to do it. Now, right now, we still have, stubbornly high inflation. We have rising interest rates, a strong and robust labor market. What does 2023 look like to you?
It looks uncertain, which is a hedge and a bad, weak, meaningless answer, and I know that. But let me step back a little bit. You're right. You've got to be forward-looking. A year ago, even before the inflationary period that we've gone through, I knew, and everybody knew, had lived through a 15 or 20-year period of ahistorically low interest rates. Some people believed it would last forever. I thought that was foolish. Remember the new monetary theory that led people to believe we could print dollars in perpetuity without any inflationary impact. I never bought that. Now, nobody necessarily could predict the supply chain impact of both COVID and then the Ukraine war and the collateral consequence of that. But certainly those two events on top of the uninhibited printing of money from the US government has led finally to the inflation and then interest rate rise that was thoroughly predictable. Now, I didn't know when it was going to start. I didn't know it was going to happen. Now, your next question is, if you knew it was going to happen, did you react accordingly? My family's in the real estate business, and I've said to my friends, my family, we should have sold everything we owned because valuations were basically being inflated. Cap rates, which is the analog to interest rates, were incredibly low. And so we just should have sold everything, waited till interest rates are now up here and bought it all back at 50% of the value, right? But we didn't do that because, as you say, you got to look forward, not backwards. I didn't know when it was going to happen, but knowing all that, what does that mean for 2023? I don't know if it's going to be 25 bips this month, 50 bips. Powell probably knows, and he's smart enough not to tell anybody, right? But I do think we're reaching the top, right? As you pointed out, inflation appears to be receding. I don't know how quickly it will drop. Some people think it was receding would have receded even without the interest rate increase because the supply chain bottlenecks were reopening and other parts of the global economy were coming back into equilibrium after COVID. Who knows? But I do think we probably are close to the top. Where it is, I don't know. When it will tip back down, I don't know. When that happens, do people think there will be an explosion of reinvestment? Let's hope so. Do they think the bond market will begin to reclaim some of the losses? Tech stocks will come back? Let's hope those things happen. But I do think since the chatter is it 25, not 50, we're beginning to see the top of that curve.
Absolutely. I couldn't agree more. Kind of goes hand in hand, right? We're still in this ongoing war, maybe a battle won with inflation coming down, but a road ahead of us that remains uncertain. Now, that's from the sheriff of Wall Street, but, or we got to get a name for you, maybe the captain of the TipRanks ship. We'll go with that one. What's 2023 look like from the captain of the TipRanks ship here?
So I think, like Eliot mentioned, it's going to be very volatile. I think there is a misconception that if the rates go down, the market is necessarily going to take off like it did in 2021. But I think that people forget that there were many other reasons that the market, that we had such a huge bubble. I mean, the entire working from home environment and all the money that was pouring on all the entrepreneurs. And I think that, even now that the interest rates are kind of stabilizing and will perhaps even at some point go down, the valuations that we've seen that were based only on the top line of the growth with no look at, the EBITDA, that is definitely going to change. And as a personal investor, I'm looking for a few things at the moment. First of all, I'm much more minded to being diversified. Most of my investments, I've moved from specific stocks, from the growth stock, the Teslas of the world, from, investing like Katie Wood into being more into ETFs, buying the S&P. Some geographical diversification as well. I still have, my favorite stocks in my own portfolio, but I'm much more exposed to the market. I'm also sitting on cash because the banks are paying high interest rates. So I think that first of all, I think that every investor should ask themselves, what taste do they have in terms of risk and reward? Because at times like this, it's also, these are also, it can also be a good opportunity to catch a good business in a bad timing. But, if you're not looking for adventures and for losing a significant amount of your investment, then I think you should be diversified more around passive investing and wait until it is more clear where the market is going to.
Can I jump in? Because I think Uri is so correct. And what I used to say when I was AG and people would ask me for investment advice, my first point was always, I'm not an investment advisor. And I preface my comments today by saying that as well. And I'm not, because it's not my area of expertise. What I've learned through experience and watching, not because I'm an investment advisor. Having said that, I always said what Uri just said, ETFs, low cost ETFs mirror the market, traditionally have outperformed individual stock picking for most investors. That's why my hero was Jack Bogle, who happened to be a Princeton alum, which is where I went as an undergrad. He was several decades ahead of me, but he came up with the concept for Vanguard and the low cost ETFs that I think should be the vehicle for most investors. And it is wise. And as Uri said, with interest rates where they are, you get a return on cash that is not insubstantial for people who want some certainty. That is a good place to put a piece of their portfolio. And I caution people, don't chase the myth. We've just gone through a period where you saw the SPAC phenomenon. which was, in my view, a complete joke. You had people saying, give me $4 billion and I'll find something to invest it in. I don't know what, but just trust me. Well, what kind of investment theory is that? Now, some of them, virtually none of them actually even got invested, let alone give a return. Put aside Bitcoin, which I've always been skeptical about just because I don't think there's enough understanding about what it is and how it works. And people said it would be the alternative to the dollar as the reserve currency. Ain't going to happen. Nobody trusts it. We don't know where it is. The dollar, thankfully, is still rock solid. You know, Washington figures, as I say, Washington's a bunch of numbnuts, but hopefully they'll figure out the debt ceiling issue. And so don't chase myths, whether WeWork, you know, the banks that wanted to underwrite WeWork when it was going public said it was worth $60 to $70 billion. It was worth zero. I was asked by Adam Newman, indirectly through a friend, to be one of their first investors. I looked at it and said, there's no business model here. It wasn't his personal peccadillos and some of the things that got a lot of attention in the movies. The business model's bad. The margins are tiny. Even if you make a few nickels, it's not going to get you to the valuation that got there. But you had Goldman, you had JP Morgan saying it was worth 60 to 70, $80 billion. Well, how do they say that? So my skepticism of those dream chasers where they say, oh, but it's disruptive. The moment I hear the word disruptive, my antenna go up. Something will be. Tesla's been disruptive. I enormous respect for Musk and the company he's built. Would I buy the stock at the valuation it was at? No, but he's been disruptive. But 9 out of 10 times when I hear the words new paradigm or disruptive, I run the other way. Not going to happen.
Red flag. Immediately a red flag goes up.
Exactly.
I almost wish to see what Adam Newman's email looked like in comparison to Uri's email that came in. But you're absolutely right when it comes to Jack Bogle. It's someone I often look up to, along with Charlie Munger and Warren Buffett and the elect. But Jack Bogle, I mean, there's nothing like getting a broad market index fund if you're looking to play incredibly safe, and I couldn't agree more with that. But I promised our viewers that we would really grill the both of you two and put you guys in the hot seat. So I'm going to go back to the captain here of TipRanks.
Sure. So I want to weigh in on what Eliot said. I mean, I know that there are a lot of stock pickers on this webinar, right? I know that they're really looking for, real tips. And my first tip is diversification and patience. I mean, that always works well for investors. But I think what will happen in 2023 because of this situation is it's very difficult to raise capital. And a lot of the companies out there are going to be in a serious problem in 2023, especially given the fact that, they can't issue any more bonds, they can't raise capital, they're basically not investable. And I think that would lead to some consolidation, especially on the SPAC area. I mean, there are companies that are trading for negative enterprise value. So you have companies, that are sitting on $1 billion or $2 billion of cash, but they're trading for 400 million or 500 million. If I were looking for adventures, and I'm not looking for adventures, but if I was looking at adventures, what I would do is I would probably start looking for those companies because of course, nothing is guaranteed, but I think they're probably more likely to be bought out by private equity firms that, are basically going to understand. And we already see that. We see some of these, companies that went public last year and they're not taking off, their revenues aren't growing. The only thing that they basically have is cash. We see that they're starting to get offers. I think the more stressed the market will be. And of course, then we have the question if the market is going to be more stressed or not. But I think we're going to see more M&As. And I think that sophisticated investors, activist investors, private equities are probably looking at these companies where they can buy them out for some premium above the market price and simply close down the business and take all the money inside.
Yeah, you're exactly right. In the real estate context, I think there are people are looking at some of the REITs that are trading at a discount, and you look at the underlying dirt that they own, even though commercial real estate and the office market is in a terrible situation for partly the reason that Uri mentioned before, the work from home phenomenon and the uncertainty about demand for office space down the road. Put that aside, there are certain companies where the underlying assets they have, whether it's cash or dirt, is actually worth more than the market cap that you would see from looking at their stock. And so those are useful investments. That happened in New York when Alexander's, which was a big retail company that owned a fair number of real estate, just owned the dirt here in Manhattan, was bought up. and they closed the company and built residential properties on the dirt they owned, made a bloody fortune. It was a smart investment, different sector, but essentially what Uri is saying.
This is great talk about REITs in different sectors, diversification, index funds, ETFs. But now is where it's going to get a little bit more pressuresome. Ori, I want to ask you, moving into 2023, and you did already touch upon this, so I'm going to go a little bit deeper with you here. Do you have any actual stocks that you're looking at? Perhaps you look into a sector, which ones, from webinar to webinar, what I'm always sharing is, hey, prepare for the worst, but plan for the best, right? Because we really don't know what's coming our way. But if we're already in preparation mode now, looking 6 months, 1 year down the road, it will help us out. Now, of course, it's uncertain, but what sectors are you looking into? And more specifically, can you give us maybe 2 to 3 stocks that you have your eyes on at this moment?
Sure. I mean, since you've asked, so I'm a long-term investor, right? And I'm not necessarily looking for short-term trends. Sometimes I will be opportunistic about it. But at the end of the day, the tech sector always wins. And maybe now is a better time to get into it after NASDAQ went down about 30% over the last year. So it might continue to take a hit, but if you're looking at the next 10 years, and I think it's fair to say that the tech will outperform healthcare, real estate, and other sectors. It is also a sector that I know better, being in the tech business. So on top of that, I'm also very strong on the fintech. So I know the business better. I know how to read the reports, and I try to read the reports and not just listen to what analysts are saying. I can tell you where I'm at, some of the leaders on my portfolio, and by all means, this is not a recommendation at all. It hasn't been performing very well last year, but one of my favorite companies is Disney. I love the content. My kids love the content. I think that Netflix built, really changed the entire industry, and now Disney, that is a content king, just needs to go in. There needs to be no investments in market education, because the market is educated. They know how to pay $10 a month, and I think that Disney is going to win in this game. It's going to outperform Netflix and Amazon and HBO and others. I invested in 2 Israeli startups. They're not startups. They're actually listed in New York. They're in the same space, and somewhere I think that at some point they will merge, but of course I have no evidence for that. They're called Taboola and Outbrain. They're both very small companies listed for about $500 million each. Of course, I'm very strong on the SPY, which is an ETF that covers the S&P. So that's actually my biggest investment, which allows me to do these small, stock picking. And I'm looking at a few other, like on my watch list. Of course, I have Apple. Every day I'm praying that it will get down to $100 a share. You know that because we talk about it in the kitchen. And then I'm going to buy it. I like the sure bets. I like Microsoft. I think they have a great business. They have a good management. They have a strong brand. They had ups and downs. And, I'm a happy customer. We're paying a lot of licenses for Office 365. We're paying a lot for their cloud. We see how it grows every month, and we have absolutely nothing to do about it. It's very difficult to move. And I'm not invested there now, but I think that I think they're running the business correctly. I would stay out of most of the ad tech. I think that, Google and Facebook, they're at this point where they're about to be disrupted. We see a lot around the AI now. It's more risky. The fundamentals are good. But, when we saw volatility with our usage last year, the first thing that we've done is stopped advertising. And, we couldn't stop paying for Microsoft, right? We couldn't stop using the Apple, the Macs or the mobile phones. And so the first thing we did is we said, okay, no more advertising on Facebook. We're going to cut at half the advertising on Google. And that kind of shows you how sensitive companies are to where they spend their money. So I'm trying to stay away from companies that I know how easy it was to stop working with them, and stick to those that I know that I can never stop working with them.
Apple is, as you shared, a stock that we often go back and forth about when that stock price drops. I know we have a WhatsApp message that goes back and forth. But Disney.
Every time Apple moves, everybody in the office gets a text from Ari. Yeah, you need to look at Apple. It's at 135. I can't believe it's now. It's on 145.
Apple.
I think Uri is saying something so important, which is that there's certain of the brands there, such as Disney, Microsoft, that will ride through the technological changes of the future because they are so well managed. And as you said, Disney is now adapting to the Netflix world. Netflix was the disruptive company. Whether it manages to survive its own streaming environment, I don't know. But Disney certainly seems to have the capacity to do so. Same with Microsoft and Apple. Google, you're right. You wonder if Google somehow is feeling pressure from too many points around it. And the focus group that I use for this is I've got 3 daughters who are 28, 30, and 33, and my wife has my stepkids are 14 and 21. So I ask them, what do you like? What software package do you like? What products do you like? And my 14-year-old a couple of years ago started talking about something called Fortnite. And I had no idea what it was. And boy, do I wish I'd listened to him, right? I mean, it was a phenomenon that took over the world. So sometimes you got to forget the analysts who are in their 30s on Wall Street, talk to the kids who are actually leading the consumer demand that will determine where the future is.
Absolutely. Trying to find those trends. And speaking of which, I know this great platform, TipRanks, actually, where we get to look, by the way, at website traffic trends. And this goes hand in hand with what we're sharing now, which is very interesting. So, Uri, you're big on Disney. And what I found particularly interesting, which we're always tracking Netflix and how much website traffic that they have. And just for all of you who are out there, if you're new to TipRanks or just joining us for this webinar, our website traffic tool allows you to go on to TipRanks, take a look at the amount of traffic heading to a specific domain. Now, why is that cool? Because we actually get to paint our trends. And so, for example, with Netflix, I know that people are going to Netflix and they're purchasing perhaps a Netflix plan to actually be subscribed to it, and then they pay for Netflix. That ultimately translates into hopefully revenue and then comes out in the earnings reports. But what I'll go back to is the last earnings report that they reported 2 earnings reports ago. They actually shared that they had an increase in users, which is fantastic. But what I noticed that I don't think a lot of people touched upon was a lot of those new users came from outside the United States. Disney had an increase from within the United States. So perhaps it's a game of catch up here, which is an interesting point that I got right from TipRanks.
Ari, you're talking about something so interesting that I haven't even thought about when you asked me how do I choose companies. So there's actually a huge trend that the SEC doesn't seem to enforce called alternative data sets. And so all these big hedge funds are spending over millions of dollars to get insights into companies way before the company actually reports. So it can be satellite images to see where commodities are, and it can be credit card data. So for instance, many companies are going to know how many iPhones were sold way before Apple actually reports it because they're paying PayPal or American Express to get this information in an anonymized way. We launched about a year ago, maybe it's even more now, a tab for those who don't know on stock pages. If they have, if they're an online business or retail business, you can actually see through TipRanks the estimated amount of people who visited their website. So for instance, you can see how many people went to Netflix every month or every quarter before the company reports, or to Disney, or to Tesla, who is reporting today, if I'm not mistaken, or to Amazon. And that's a very strong signal. The fact that you can see like an estimated ballpark before the company reports, you can see if the trend is up or down. And that's another tool that I personally use before any screener to see if it makes any sense to get into the company. Now, of course,
Uri, can I interrupt? Because this goes to the question you asked about half an hour ago: is the playing field more level now than it used to be? And my answer, and I think what Uri is saying goes to my point, there's more information out there now that can be accessed. So there's more level playing field if you know how to access it and use it. And what Uri is describing is a very sophisticated data search that, but you're right, you know how many ships are carrying oil. You can see them from satellite imagery, or you can see how many people are going to Netflix, the website. So you can predict before a quarterly report. Used to be with only in a quarterly report, an SEC filing, you get that data. Now you can get it through other mechanisms, which permits you to be ahead of the curve. but you need to know how to do that. And that is where the major hedge funds or a Uri or TipRanks permits you to be competitive.
And that is one of the things that we want to keep disrupting, by the way. We want to bring more and more of these unique alternative data sets and to make them available to our users. And that is actually a real challenge because some of these data sets are sophisticated. I think that the average user doesn't know what website traffic even means, how many people went to the app or to the website. And it takes years to give investors this edge.
So not to go down this rabbit hole, but you mentioned Netflix and the Disney and streaming services. There was an article the other day that there are now so many apps and streaming services that consumers are getting confused. You want to watch Yellowstone, but wait a minute, which app is that on, right? Yeah. You want to watch your favorite show, or do you subscribe only for that 1 month? And so even though subscriptions are up, is the churn going up? So the net subscriptions are going to stabilize. It's a much more confusing environment. And so that's why the Netflix world that they created with brilliance is now a much more difficult world to navigate in terms of the content and holding on to their consumers and getting the revenue from it, either subscription or ad-based, whichever way they go. So that's where the complexities begin to emerge.
And so here's a helpful tip, right? Let's say Disney releases a new hit, right? Like Avatar 2, or Apple releases a new iPhone version. A week after, the media is going to talk about, some early estimations of how many tickets were sold or how many iPhones were sold. But actually, if you go and read reviews on the first day, you can already understand if the product works or not. If Avatar would be a disaster, people won't go to see it. And if it will be good, the reviews are going to be good. It's going to go out. They're going to break new records. And usually when it is published, then you see the stock market move. So if you're in it for the short term, that's a classic alternative data. You go to a review website and you already know what the results are. You can guesstimate the results based on that and make an educated decision. And I think, that's what differentiates between a smart investor and an average investor that's going to go on Twitter and going to say, oh my God, look, people are talking about Tesla. That's where I need to invest.
And that's right on the money, because our last webinar, we did talk about our website traffic tool. Okay. And it was interesting to note that we actually accurately predicted here in the office, based on using that website traffic tool, how Netflix would report. And so we saw the trend, and not only that, but what follows that trend line when there's more users to Netflix, that would, at least what we've seen, or I'll say what I've seen, is that the stock price actually follows. It's not always the case, right? You have to do your due diligence and use multiple tools, but this is really all part of bridging that gap between Wall Street and Main Street. We're putting this data, this information that's so pertinent to every single investor into your hands, whether it's your mobile device or just going onto your computer to find it. And that is, you cannot get better than that. The Sheriff of Wall Street, I want to go back, Eliot, to you, because we had Uri share with us his stock picks, the sector, and then the stock picks. But what sectors are you looking at for 2023? And more so, what are 2 to 3 stocks that you have your eyes on? I know you're a real estate guy, but maybe we can get more into the stock market and see what stocks you're looking at.
I'm going to do what I was trained to do when I was in politics, which is dodge the particular stock answer, because as I said before, I've never been a stock advisor. I don't want to recommend a stock. I just don't know enough to give. I don't want anybody to rely upon my advice on a particular stock. And then, I don't feel competent to do that. I'll say this. I agree with Uri about technology. Technology in the long run wins. And it wins at many levels. 1, there's a positive return. 2, it transforms society. 3, I think it improves our lives, which is the most fundamental point. I think it also wins. Antitrust cases usually are rendered irrelevant because of new technology. And I know, even though I was AG, we brought the antitrust case against Microsoft. It really was irrelevant by the time Microsoft had expanded. Look at the IBM mainframe case. So technology wins. And so I think tech stocks, if you have a broad base of investment in them, because some will win, some will be rendered obsolete by a better technology within their sector. And second, I believe in real estate. I really do. You need to be careful. You need to pick. I'm glad I'm not in the commercial real estate sector, which means just office buildings. For a bunch of reasons that I too lengthy to go into here, but residential real estate works. People will always need a place to live. They'll always want a better, more modern technologically adept home. That's what we build. That's where our family's investments are in, and we've done well.
It's fantastic. And speaking about real estate and stock market and diversification, now I know this TipRanks is primarily with the stock market and the market, but how would you, both of you guys, I'll pose this to both of you, how would you diversify percentage-wise for 2023 if you had to share thoughts on, perhaps 30% bond market or, into real estate, going real estate heavy? How would you share your thoughts on diversification for 2023?
So I'll start. I think that it's, that's such an individual question. It really depends on what are your needs and, again, your risk appetite and when do you actually need your investment back. And I think it would be irresponsible to give advice without meeting a professional investment advisors that will walk you through the models, especially now when there is so much uncertainty. But there's no question that diversity is a good thing. I think that it's actually the most important thing with investing more than, a winning stock. So I think that, you need to consult with someone professional to understand your real needs and then decide how you want to diversify.
And I think Uri gave the perfect answer. I'm certainly not going to try to amend it or overlay anything on top of it. And there's so many fundamental questions. And you asked the first one right at the top, which is which way are interest rates going? And so you need to make a judgment. And I don't have a crystal ball. I don't want to pretend to have any wisdom on that. But people will have to make a judgment, both in terms of their risk appetite, which way will fundamentals go, such as interest rates, because that will have not a ripple effect, a tsunami effect on asset valuations and stock market valuations as a consequence. And so those are the sort of fundamental decisions people have to answer. And then the response to your question will flow from there.
And that's, I think, key. From webinar to webinar, what I've heard or have been asked a lot of the times is actually about diversification. If I'm really tech heavy, 90% into tech, 90% or 50% to X and 60% to what. So what I'm always sharing with people webinar to webinar is that, again, it's about your preparation now, understanding your financial context, what you're looking at. If you're nearing retirement, it's going to be vastly different from perhaps an investor in their early 20s or just getting started in the stock market. However, it all loops us back into knowing who to trust and having the right tools, the toolbox, if you will, to utilize to be able to make the most informed investment decisions. Now, here's where it gets fun, because just at the very beginning of 2023, we had our first webinar, and I was able to share a couple of the new features, but here to talk about newer features to come in 2023, which we were actually not going to go down this route because we were going to save it for perhaps a couple of weeks until we fully rolled out all these new features. But because our captain of TipRanks, Uri, is here with us, I want to put you on the hot seat and say, what new features are on the way for 2023 and when are they rolling out? What details can you give us?
Sure. So I'll give you what I know. And I can tell you that everything I say a week before it's supposed to go out, our product team is going to come and say it's not ready yet. But let's, going back to diversification, I realized that one of the tools that we actually have allows you to sync your portfolio with your bank. And then there is a crowd wisdom page where you can actually compare your diversification to the crowd. So of course, I mean, everyone has different needs, but if you are really curious to see how other investors on TipRanks have diversified their portfolio in terms of asset classes and geolocation and stocks, then you can see it on the smart portfolio. Now, what we're doing this year, and it's very interesting because 2022 was very different. It was a very unique year. We understood that the needs of our users were different than they were in 2021, because in 2021, everybody wanted to learn more about, the meme stocks. What are people talking about on Reddit? What are people talking about on Twitter? What is Katie Wood tweeting? Or, what is Trump tweeting? And so we kind of moved to more responsible investing. And so, I mean, the first exciting announcement, and the people on the webinar are actually the only one to hear about it, because we haven't even done any marketing around it yet, and we probably will announce it in a couple of weeks, is that yesterday we launched our first ETF pages. So you can actually go on TipRanks now and search for SPY, QQQ, and all the ETFs around the world, actually. we have all the underlying assets under every ETF, so we can show you what are analysts saying about the ETF on a weighted basis, what are the quantitative scores, which hedge funds have been buying it, and a lot of other unique stuff. We're trying to get into this market and again create a data-driven score for ETFs. We have also recently launched a few new websites. I know that someone asked when are we getting into Germany and covering their market. So in the last 2 quarters, we opened our coverage to the Australian market, in Asia and Australia and in Singapore. And so far, knock on wood, that's going excellent. We're seeing a lot of very happy users in that region. And we're planning to open it to the Hong Kong exchange later this year as well. We have made our service available covering the German market and UK and in Spain as well. So we kind of expanded our geographical coverage, which was something that came, feedback that came from many of our users. We have added ETFs, we have added advanced charts. One of the feedback that came many times, we're using all these services for advanced charts, and you really need to improve that as well. And we spend a lot of time and resources to make sure that we have all the features on TipRanks, and so far it looks pretty successful. We see that a lot of users are spending a lot of time on these pages. Now what? And so we are releasing a few very exciting more things in the next few quarters. We're adding a technical analysis feature where you can see all the moving averages and all the studies in one place as well. We know that is the top priority based on feedback that we received from about 5,000 users who answered our polls. We are starting to cover option chains on TipRanks. So for every stock, you can actually see the pricing of options, and we will add, of course, option screeners, ETF screeners, and and this is something that we haven't shared with our retail users, but about a month ago, maybe before that, let's jump back. A big part of TipRanks, surprisingly, is working with banks and financial institutions who license our data and make it available to their own clients. So for instance, in the US, we have TD Ameritrade, we have E-Trade, we have Interactive Brokers, we have many hedge funds that are actually using our data. And our goal is, of course, to level the playing field for the retail investors. That's where like 95% of our resources are allocated. Why am I saying that? I'm saying that because now our goal is to, a few weeks ago, we were thinking, let me even go back. When we did this polls, one of the things that we're really missing is news, breaking news, how to be the first one to update our users on what's going on in the market. Many users don't really want to use screeners. They don't want to, they don't want to do all the slicing and dicing. They're just like, feed it to me. And so a few weeks ago, we announced our first acquisition in the US. We have bought an amazing company that's been around for 25 years called The Fly, or The Fly on the Wall, located in New Jersey. And the good thing about TipRanks is that we analyze all the news in the world. That's actually our core technology. And we realize that that specific company are always the first one to go out with not all items, but with most of the items. And we've been analyzing them and visualizing it. But now we hope to slowly integrate their service inside TipRanks as well and make it available to all our enterprise clients. So we're going to see more content on TipRanks. We're investing a lot, as you know, Ari, in webinars. We want to make sure, and in product marketing in general, we have so many different tools that we've been developing over the last years, and most of our users don't even know about their existence. They know that they only need to come back and see what analysts are saying. So we have news, we have more content, more product marketing. We're going to offer tools around options. We're going to offer more tools around ETFs. And we're going to offer technical analysis and expand our global coverage. It's actually pretty cool because on the webinar we did 2 years ago, we promised our users that we're going to have an Android app, and we're going to have coverage in Canada. So from webinar to webinar, it's great to see how far we have progressed.
This is absolutely incredible. I'm excited, not only because I work here, but because I use TipRanks every single day that I actually look into what stocks I myself want to invest into. And, last webinar, we talked about website traffic. The one before that, we're talking about dividends. every week we're talking about brand new features. So I'm excited to see how these features will play out, how we're able to utilize them. And with that being said, I want to share that in the chat, what we do every webinar is that if someone has an idea, they can throw it into the chat. If they have their thoughts on a specific feature, they can throw it in there. And we actually utilize everything that everyone says, because at the end of the day, we're here for you guys. I mean, I'm a customer success manager here at TipRanks. We have Uri here with us. We have the Sheriff of Wall Street on with us, but we're really all here for you guys because it does come down to this mission of leveling the playing field and bridging the gap between Wall Street and Main Street. So with that, guys, I have one last final question for you. Now, I just want to know, my favorite tool that was actually just released on TipRanks is the best analyst tool, because I can actually go to a specific stock that I'm really interested in, and I can go to the analyst section, and I'm not going to have to sift through anymore a bunch of analysts, perhaps a one-star analyst that says something about, if I'm looking at Apple, I can actually find the best analyst within the radius that I'm looking at, a month, 3 months, 1 year, 2 years, of which analysts I should be following based on my investment strategy. Now, that's my favorite tool because I no longer need to be this coach who's scouting for the best player, if you will, to be on my team, right? For picking a stock, I got it right there. So the best analyst tool is my favorite tool on TipRanks. Eliot, I'll come to you first. What is your favorite TipRanks tool that you've used and actually have seen a ton of success with?
Well, I'm going to parrot you, and it's because my interest in this began with analytical work. So I want to see which analysts are good. Do I know them? Did I prosecute them in the past? Because they cleaned up their act? So I like that one. But my second favorite tool is calling the captain of the ship. I call Uri, and I say, "Hey, Uri, what should we be doing?" Because he's still the best guy out there. So I tip my hat, not just TipRanks to Uri, who, if this is my last chance to say it on this webinar, has done a remarkable job doing something that A, has built a company, B, has made some money for him and for the investors, but C, much more important, has begun to, as you said, level the playing field, and that is critically important for investors around the world. And so, Uri, congratulations. It's been a fun ride, and it continues.
Thank you. I really appreciate it. And actually, it's pretty funny because when we started the company, I'd ask, I'd be invited to meet with different hedge funds. So I'd always call them before and say, "Eliot, before I go there, I need to know, did you prosecute them, or can I tell that you're a board member at TipRanks?"
Talk about a police force on Wall Street in the making. Now, your favorite tool, your go-to from the CEO, the founder himself.
So it's a great question. I use a lot of the tools on TipRanks. I use the website traffic a lot, but I'm addicted to our mobile app. I visit it 20 times a day, at least. Like every hour I look at it, and it just has all the information in a very simple way. Yesterday, we have changed the homepage of TipRanks as well. So you now see the futures, you can see, the recently viewed stocks. And so I started moving from other websites where I'd see all the information in a convenient way now to the dashboard on TipRanks. And of course, before I make a decision, I see what our analysts saying, and I screen out all the underperforming one and try to see who is the best analyst and what is he saying and why do they think it's a good investment or a bad one. And that's actually a very important thing. And, since we have many TipRanks users now, my biggest recommendation is that, try to understand why are the bearish analysts bearish. Not only retail investors tend to search for excuses to invest in a company because they need to convince themselves. But sometimes it's much better to understand, why are people against that company? What do they know that you don't? I think that's where you usually find a lot of value.
Short analysts are more interesting to read.
That's true. And it's another interesting insight is that when you look at the analysts from the tier 1 banks, like the Goldmans, they usually underperform the analysts from the tier 2 and tier 3 banks when we looked at the top 100. But now that the market has changed, and the reason for that, by the way, is that the tier 2 and tier 3 analysts are usually 93% buy and then 7% sell. The big banks, maybe because they are more concerned about regulation, usually they're going to be 60% or 70% bullish. And when I say bullish, I mean buy and neutral. And then 30 to 40% sell. And in the last year, we suddenly started seeing a shift in the top 100 analysts, and we see more and more analysts from the, I believe they're called the bulge bracket banks, like the top 5 banks. And that's only because they were at least responsible enough to be bearish with companies.
Correct.
Wow. So everyone, you've heard it here first. You've heard it from the captain of the TipRanks ship, the sheriff of Wall Street. Now, I want to extend a thank you to every single community member of ours at TipRanks who has joined us for another webinar here at TipRanks, and extend a special thank you, Sheriff Eliot Spitzer, to you for joining us on this webinar. Our CEO, our very own Uri, who has also joined us. Now, guys, it would not be a TipRanks webinar if I did not say to go check your emails, because we have sent you a special gift, as our mission is to level that playing field and, of course, bridge our gap between Wall Street and Main Street. Everybody, thank you so much for joining us, and we look forward to our next webinar on Monday of next week. It is an honor and a pleasure to be here with all of you. Thank you so much, and I'll see you next week.